Ladies and gentlemen, good afternoon. This is Christopher Aaron. It is the 16th of March 2017. This is a special broadcast. This is not our regular weekly update. This is a broadcast in which I'm going to discuss the Commitment of Traders Report, the COT Report, as it is called. There have been some reports that have been coming out recently, both in videos and also in print format, in various corners of the investment world that have discussed the Commitment of Traders Report and painted it as very negative for precious metals, as if what is being said in the Commitment of Traders is going to result in a severe drop in the precious metals. And I believe that this analysis is faulty. So I'm going to present in this video the data that shows that an increased net short position in the Commitment of Traders Report is actually a sign of a healthy market and is not something to fear. Thank you very much for being with me. Now, just before we get started here, I want you to know, if you are listening to this video, this is not a personal attack on anyone who is claiming this sort of analysis on the Commitment of Traders. Okay, there are many ways to interpret the market, and I appreciate different forms of analysis. That said, I'm going to call a spade in this video, and I believe the idea that the Commitment of Traders Report is a valid determination of the prices of the precious metals is simply wrong. So let's get into this. We are not going to look at the metals today. We are going to switch right over into the Commitment of Traders Report. Please see the regular weekly update for the update in gold and silver. What is the Commitment of Traders Report? This is a report that is published weekly by the U.S. Commodity Futures Trading Commission, the CFTC. And the report shows the total open interest in the futures contracts of both gold and silver and a number of other commodities. But we are concerned here with gold and silver of the following categories. Okay, so you have first commercials, and the CFTC defines commercials as those entities that are engaged in business activities hedged by the use of futures or option markets. In other words, this is the big banks and the big mining companies. These are referred to as the commercials. Okay, they're engaged in legitimate, quote-unquote, business activities using the futures markets. Next, we have non-commercials. Okay, these can be very big entities. These can be smaller entities. We are talking about hedge funds, traders, speculators, investors, etc., etc. Anyone coming into the futures market looking to profit based on a movement in gold and silver, either higher or lower, I would be called a non-commercial. I have bought and sold futures in the past, so I would be a non-commercial player. The final category here is what is referred to as non-reportable. These are basically, it's a very small percentage of the total. It's usually less than 10%, and these are unknown to the exchange. For one reason or another, the exchange doesn't always know which category these players are fitting into, so they just call them non-reportable. Okay, and these are not my definitions. These are the definitions by the CFTC. Okay, so what does the Commitment of Traders Report look like? Here's what it looks like. It's a numerical report. This is the most recent one from a week ago. In silver, you have various categories. Open interest, these are the commercials, these are the non-commercials. They call them different categories in this report than they do on their own website. Don't ask me why. Here's the non-reportables. The numbers add up to show you who's holding long and short contracts across the silver market here on the COMEX in the United States. Let's get rid of that. That is not the best way, however, to look at the Commitment of Traders Report. Let's look at it as it has been shown in some recent analysis, and I will then show you why the recent analysis has been faulty. Let's put this into graph format, okay? Now, this is what I have seen in some other reports, and let's go over this really clearly. This is the silver commitment of traders report that we're looking at. So there's different sections here. If you're not a graph person, I'm going to go a little bit slow in the beginning to show you exactly what's happening, and then we will put this into perspective, okay? So the top part shows the price of silver over the last year. Okay, the price of silver in US dollars having fluctuated from the 20s down to the lows here. Excuse me, this is a 2-year chart. Back to the lows down just below 14 at the end of 2015, early 2016. The recent high at $21 last summer and coming back right now to around $17. Okay, price of silver is on the top. Below this, we have graphs that are moving in opposite direction, showing on the top the non-commercials and the non-reportables. Okay, the non-commercials are shown in red. The non-reportables are in this little line behind the red over here. And on the opposite, the commercials shown in blue. Now notice the commercials at negative 106 equals the sum of the non-commercials plus the non-reportables with a little bit of a rounding error. This comes to 105. This is negative 106. So what are we showing here? It's that for every long contract, there must be a short contract. Think about this for a moment. As we look at the data point that has been brought to our attention recently as being an extremely negative, this is being portrayed as an extremely negative situation for the price of silver, that the price of silver is set to move a lot lower because the commercial short position here is at some of the highest levels that we have ever seen. You could see that right here. The highest level that we've seen right here around negative 110 being matched recently on this most recent increase. So what I'm going to show you is why a high short position by the commercial traders is not a negative. It is actually a positive. It is actually a sign of a healthy market over the long run. Okay, let's switch over to look at the exact same chart for gold. Okay, so here we have the price of gold over the last 2 years. Here we have the commercials on the bottom in blue. We have the non-commercials and the non-reportables here on the top. And here was that record short position that we saw that over the short run did correspond with a short-term top in the price of gold. But it is very, very slippery of a slope to say that a short-term top is equal to a long-term top. In order to understand why, we have to back this chart out to a much longer perspective. And this is the big thing that I see happening quite often. People are looking at short-term charts and they are making a call based on a short-term chart without looking at what the long-term data shows. So we are going to take the same gold commitment of traders report and we are going to zoom it out, showing 16 years worth of data. And let's just cover up the part here that I want to show you item by item. So we're looking at the exact same thing here, the gold commitment of traders report. And this is going back from the year 2000 up through mid-2016. This is the best that I could find. These are publicly available charts, by the way. I just found them in an internet search, and I am just analyzing the data for you. So we have blacked out here everything for a reason, and I want to show you why. So if you were a gold investor, let's go back to the year 2002. If you were a gold investor in 2002, when the price of gold here was just around $350 an ounce, and you saw this data point, okay, this is the same data point that is being discussed right now as extremely bearish for the price of silver. You saw this. What you were looking at here is, at the time, a record short position in the commercial, the blue, for the gold market. Okay? The record short position, if you just follow this to the right over here, was somewhere around 75,000 contracts short. So if you were looking at this when the price of gold was around $350 an ounce, using that same analysis that we are seeing today, you would have said, logically, the commercials are short. They're going to bring the price way down because the commercials are always right. Therefore, I should sell my gold. I should not be buying gold right now. Let's look at what happened with a record short commercial position. Okay, we expand this chart another 2 years here. You had an increase in the record short position and what? An increase in the price of gold, okay? From about $350 to $450 an ounce. And you had the short position by the commercials go from this around 75,000 to almost 150,000 short. So an increase in the short position by the commercials, the so-called smart money, and an increase in the price of gold, not a decrease. Let's fast forward this chart another few years, and we see again going into 2006, an increase, a new record short position in the commercial traders, the banks, and the mining companies, and another $100 increase in the price of gold, this time from around $450, where it was at the beginning of the last arrow, to around $550. Fast forward this again one more time. Look at this. You go another couple years into the beginning of 2008, another record short position and another new high in gold, this time going from around $550 to just around $950 an ounce in the price of gold. Do it again. Look, there was another peak in the net short position of the commercials, and the price of gold continued to move higher. So what can we say? I mean, guys, I'm not sure how much more clear this can be. If you look at this with the proper perspective, you can see that as the price of gold moved from $250 an ounce in the early 2000s up to $1,900, what happened? The commercial short position made new peaks the entire time. Furthermore, the highest that the net commercial short ever was here in 2010 did not match the peak in the price of gold. If you were using that analysis here in 2010 and saying it's time to sell all your gold, you missed one heck of a move here from 2010 to September of 2011 as the price went from about $1,200 to $1,900. We can look at this the same with the silver commitment of traders report. Just look back. Now this chart, again, publicly available. This chart, not the recent chart. This is an older chart, 2005 to 2015, the beginning of 2015 or so, mid 2014. Look at where the record short position here matches up with the price of silver. Look, this was the previous record short. It matched up to silver here at $9 an ounce. So if you had used this form of analysis and said, oh, the price of silver is going to go way down because of the commercial short position, you missed the move from $9 up to $49. Or even if not that, you missed at least the move from 9 up to 15 here over the next couple months. Look at this. Okay, the short right here and the price of silver moving 50% higher from a record position. So, guys, the executive summary here. Open interest should expand. It should increase as a market progresses. You're seeing open interest increase in the gold and the silver market because there's increased interest in this market. That is a healthy thing in the long run. Every new long contract, which is included in the open interest, requires a short contract. Think of that. There can't be a buyer without a seller. So when you see a record short position, it's indicating that there is record interest in a market. This is not a negative thing, especially when the price of silver is as it has been. It has fallen by about 70% over the last 5 years. It is not a negative thing to see a record interest at this time at such low prices. As we have shown, past peaks in commercial short contracts have not coincided with peaks in the metals. They just haven't. We've shown that right here. Okay? If you looked at any of these previous peaks and said that was going to be a peak in the metal, you missed a 10-year bull market. I think we are looking at a similar situation now. We're getting ready to start a move over the next several years that is going to develop. Now, I am not a perma bull. I do think there are peaks and troughs in the metals. I also trade the metals. I'm willing to go short the metals if I believe they are going to fall in price. The big point of this is that prices may rise or prices may fall. This requires other forms of analysis, but it is not because of a record short position in the commercial category. So thank you very much for watching. Once again, this video is not a personal attack against anyone in the investment or the precious metals world. However, I do believe the form of analysis that was presented is clearly inaccurate regarding the commitment of Traders Report. We can see very clearly from the data that an increased commercial net short position, if anything, has corresponded with increasing precious metals prices. It is a sign of a healthy market. It cannot be used to determine what is going to happen to the price over the short run. We have to use other forms of analysis. And if you have found this form of analysis beneficial, that is what I attempt to do. I do not sell any precious metals. I do not work for a mining company. I do not work for a bank. I am looking out for the best interest of my subscribers in this form of analysis and other forms that get into more specific recommendations for buying and selling of the various instruments. That is what goes out in the weekly premium research. You can find more about that on the website. I do also work with some individuals on a one-to-one basis if you require an independent perspective on your situation with the precious metals. Once again, thank you for watching, and we'll be back next week with the regular weekly update on Wednesday evening.